Hey, welcome to Chapter 5 on job order costing. We're talking about in Chapter 5 and its sister chapter, Chapter 6, are job order versus process costing. We're looking at ways that a company manufactures its product or provides its service that would help you to determine which costing system makes the most sense so that you can accurately keep track of the costs and hopefully use it to set your pricing. So we're going to divide our companies into two major types. First, we have process costing. Those are for companies that process all the same kind of things. So they provide products or services that are essentially homogeneous or identical and can be utilizing this process costing system, which we're going to talk about in Chapter 6. If your product or service is unique, then you would fall into the category of companies that use a job order costing system. So what a job order costing system looks like is you provide your product or service something that's unique and different, something that would allow you to keep track of costs for that particular unit, whether it's a product or a service. So some examples here, printing, construction, furniture making, automobile repair, all those kind of things would make sense for a job order costing system. So what we're talking about, the easiest way for me to tell you whether something should be process costing or job order costing is if you think about the product or service that's being manufactured, okay, and you said, okay, let's for instance say I build homes. Could I take the total cost of building 10 homes and divide by 10 and say therefore my cost per home is X? Most of us would say no, that doesn't make sense because the houses could be very different in cost. It could have different features inside, different kinds of tile and paint and woodwork and everything else. So most of us would see that wouldn't make sense. That would tell you that particular company should be a job order system where we would keep track for each of those individual 10 houses how much money, time we spent on that particular unit. However, let's say I'm making cupcakes in my kitchen and I make 30 cupcakes. It makes perfect sense to take the total cost of my cupcakes, you know, everything I put into making it and the labor, and divide by 30 and get the cost per cupcake. That makes perfect sense. They're all the same. That would indicate to me it's a process costing system. So that's the easiest way to define for yourself which system you should be using, and then we'll get into what the systems do for us here. So in a job order environment, we're going to accumulate costs by job. Okay, so we're going to have a job order costing system. That means we're going to keep track of what happens for a particular unit or a particular service that we're doing. So if you go into your dentist's office, they don't just say, oh, here comes another one and check you off. They keep track of what you're doing. Okay, we did a cleaning, we did a filling, and for you, they're tacking on each individual cost and adding it up, and they're going to charge you that. For a process system, we're going to take just the total cost and divide, like we talked about with the example with the cupcakes. So things like food canning, a petroleum industry, making pills in the pharmaceutical manufacturing industry, those would all be perfect candidates for the process costing system. So here's a quick chart that summarizes those differences. Job order costing, different distinct products or services. We're going to accumulate the cost by job. And for the unit cost, we have to just look at the cost for that particular job. For process costing, we have homogeneous or products that are all the same. We're going to accumulate the cost by process or department, and then we can divide the cost by the number of units to come up with the per unit cost. So what we're looking at when we do costing systems is the difference between actual and normal costing, okay, whether we're using job or process costing. And this gets into a little bit of, you know, you may think a lot of terms are being thrown at you, but if you just think through it, it's pretty commonsensical here. Okay, so an actual cost system, just like what it says only the actual costs of direct material, direct labor, and overhead are used to determine the unit cost. So if I ask you how much it costs to make a cupcake in your kitchen, you're going to say, okay, here's exactly how much all the ingredients cost me, and here's how much labor it took. So I'm going to look back historically and tell you here's what things cost. The problem is that that's not always very useful to us. Okay, we have overhead relationships that we don't easily see in those cupcakes. So how much of the lighting in my kitchen or the gas to power my stove do I assign to that product? We have overhead costs that don't happen evenly throughout the year. So should something cost me more in July because I had to cool my kitchen than it cost me in December when I didn't? That might not make sense, and our customers might not want to pay different prices, you know, depending on the time of the year. We also have sometimes uneven production. So I may take some fixed costs and divide it by a higher or lower number depending on what jobs I had to do that week. So a normal costing system says, you know what, we're going to estimate the overhead. We're going to determine the direct materials and the direct labor because that's pretty easy to keep track, but we're going to come up with an estimated overhead system. So an estimated overhead is just a way of allocating a cost that we know is hard to trace to an individual unit so that we can make it useful. So we're going to take the overhead that we anticipate. If we've been in a business for a while, we have a pretty good idea of this. If not, we're going to do some comparisons and look at businesses like us to try to determine it. And we're going to come up with a predetermined overhead rate, and we're going to use that all year long to come up with our costing. This is what most firms use, okay? So if you go, let's say, and have your house built, you're going to build a house, and they're going to track on your job, they're going to track every hour the carpenter was there, they're going to track every piece of tile and woodwork and everything else that went into your house. They're going to keep track of those directly. Then they're also going to charge you a certain amount, probably per square foot of your house, to compensate for the foreman's time, for the paperwork and the permits and all those kind of things that are much harder to keep track of per your house, but certainly have to be part of the cost of the house. So they would do that using what we call normal costing. So when we do these cost information, we really have to look at these unit costs. And the reason why unit costs become so important is because we make a lot of decisions based on them. Biggest one is for setting prices. And once we understand our costs, we can understand, number one, what our price could be. Number two, if we should go ahead with the product. So if our costs are higher than the price we can command in the marketplace, then we know we probably, not a good business decision for us. We need cost decision to value our inventory and put it on our balance sheet and report that to the public. We have to figure out our income, obviously, and make a lot of decisions. So we have to come up with those, an accurate way to come up with those costs. We use our cost of goods sold. Remember back in financial accounting, our cost of goods sold is what helped us when we built something. Let's say we built a product. Okay, we built something, we put it into the marketplace. Before we put it in the marketplace, let me step back. Okay, so we build a product and we have it ready to sell. So before we put it in the marketplace, it's going to sit on our shelves for a little bit. When it's sitting in our shelves, it's part of our inventory and it's on our balance sheet as an asset. Then when somebody orders it, so when we send it out to the marketplace, it becomes a cost of goods sold. So we transfer that dollar amount that was sitting on our balance sheet as an asset, and we move it as an expense on our income statement, which is cost of goods sold. And we do that, if you remember, because of that matching concept that said as soon as I recognize a revenue from a sale, I need to recognize the cost that went into making that revenue in the same period. So our cost of goods sold was the cost of the inventory that we've now sold, and we put those two costs together so that we can see the profitability of what it is we do. So in the long run, any product should cover its full cost. Its full cost would include not only the direct materials and direct labor, but its share of the overhead. So that applies to whether you're talking service, whether you're talking nonprofit, whether you're talking manufacturing operations. Everyone has to at least be able to cover their costs and hopefully have more left over to make a decent profit. Okay, service and nonprofit firms also require cost information. The units might sound different, and sometimes we think of nonprofits as charities that don't care about cost, but that's not at all true. Businesses, whether they're for-profit or non-for-profit, still have to be run as a business, and they have to figure out whether they can provide the services to their customer in the most efficient manner. And if their customer is a charity or if we're trying to cure a disease, they still want to take the dollars in and use them to the best possible means. Not that they're making a profit, but they want to have that money work as hard for them as possible. So for a hospital, they would accumulate costs by patient or patient day or type of procedure. So we don't have inventory per se, but we certainly have costs that we have to accumulate, and we still have data that we have to gather. So let's go through our steps here when we use normal costing. Our steps, we're going to, again, estimate overhead and apply it to production. So first thing we're going to do, step one, we're going to calculate the predetermined overhead rate. Okay, the predetermined overhead rate is going to say, all right, what number am I going to use all next year to assign overhead to my jobs? And step two, I'm going to apply that overhead to production throughout the year. So again, if I'm building my custom home and I decide, you know what, $10 a square foot is what's going to be the overhead cost, Then as I build each home, depending on its square footage, I take $10 times its square footage and assign it an overhead cost. At the end of the year, we're going to get to step 3, and we're going to have to reconcile a difference. So we're going on estimates all through the year. At the end of the year, we're going to have the actuals, and we're going to have to adjust. We're going to either have applied too much or too little, and we'll have to adjust so that all of our records are accurate by the end of the year. So in other words, I may have assumed when I come up with my predetermined overhead rate that my electrical costs were going to be $1,000 for the year. But at the end of the year, my electrical actually ended up being $800. For some reason, I was much more efficient than I planned. Maybe I had to use my air conditioning less. So I'm going to have a $200 difference. I'm going to have to recognize that so that by the end of the year, my financial statements will accurately reflect those costs. All right, so let's take these one step at a time. Step 1, we're going to calculate the predetermined overhead rate. So what we're going to do is take the total estimated annual overhead by the total estimated level of activity for whatever the cost driver is. Okay, that cost driver will be different depending on the company that we work for and the type of product that we produce. So one company might use their cost driver as being miles. So if I'm a delivery company, I'm going to say, all right, what drives my cost the most are the number of miles I have to drive. So that might be my cost driver. If I'm, in the cupcake making business, it might be the number of hours my oven's on. So I'm going to use oven hours as my driver. Some other company might use machine hours. Back to the home builder, they might use square footage. So whatever I think drives overhead is what I'm going to use. And this is just an estimate, just an approximation. So when we do this estimation, again, we don't know exactly what's going to happen. We're going to take the data we have from previous years if possible and estimate the amount of overhead we think. So utilities, indirect labor, depreciation, whatever it is, I'm going to try to calculate based on history and based on what I think is happening this year, if gas prices are going up or if I expect some efficiencies. I'm going to come up with a number. Okay? When I have that number, so I've come up with my overhead rate, now I have to apply it throughout the year. So the application is pretty simple. I just take that predetermined overhead rate and I multiply it by my actual activity level. So if I did it by machine hours, then for this job, if I ran 100 hours, I'm going to take 100 hours times my predetermined overhead rate and charge that as overhead to the job. So I'm going to change it for each of the products that I use. I have my predetermined overhead rate, and I'll have probably a different activity level. So one took 100 hours, one took 200 hours, but my overhead rate I'll just multiply by that. So if I'm the home builder, again, the 3,000 square foot house is going to get charged more overhead than the 2,000 square foot house because I'm going to take that same rate and multiply it by my cost driver, in that case square footage. Okay. So once it's calculated, I can come up with the total cost. My total cost, again, will be my direct materials, my direct labor, and my applied overhead. So my direct materials and direct labor are easy to keep track of by the job. I can write them down, say, here's how many hours this person worked, here's how much the material costs, and I put that all together directly. And then I apply the overhead based on what we just talked about in steps 1 and 2, and I get my total cost. So let's take a look at an example here. In Cornerstone 5.1, which you could follow in your book. Okay, so we have the Argus company with overhead of $360,000. They've estimated direct labor costs of $720. Okay, here's the information. They use normal costing and they apply overhead on the basis of direct labor cost. Okay, so it tells you their direct labor is total direct labor hours worked multiplied by the wage rate. For the month of February, direct labor cost was $56,000. So our step number 1 is what's the predetermined overhead rate? So what we're going to do here, where the $360,000 is, we take our estimated overhead, $360. Now we have to divide it by whatever our activity level is. In this case, the problem told us we apply it based on direct labor cost. So our activity level is direct labor cost. So we take the $360 divided by the $720, and we get 0.5 or 50%. So that says for every dollar that I have in direct labor cost, I'm going to charge 50 cents in overhead to that job. So you can see here in February I had $56,000 in direct labor. I'm going to charge it 50% and I get $28,000 in overhead. So you can see for February I would have $56,000 in direct labor, $28,000 in overhead, and then whatever I would have in direct materials would make up my total cost. So what we have to do then in step 3 when we're all done with this is we have to make things right. So we're going to reconcile our actual overhead to our applied. So we're going to have two types of overhead. Actual overhead, these are the costs that are tracked throughout the year in the overhead account. This is the electrical bill when it comes in, this is the depreciation, this is the indirect labor, all those bills that are coming in with actual numbers on them. The applied overhead is what I predicted would happen and applied to the jobs. So I'm going to keep applying those all through the year. I'm going to be wrong. Very, very, very rarely would I be 100% right on actual versus applied. So I'm going to be wrong, and I'm going to have to reconcile it at the end of the year. Hopefully I'm not off by much, but I do have to fix it. Okay, so I reconcile any difference by applying it, correcting cost of goods sold. Okay, that's the account I have to hit. So we call that an overhead variance, the difference between the actual and the applied. Okay, so in this case, our actual overhead is $400,000, but we applied $390,000. So that means we under applied overhead. We have $10,000 that we should have applied that we didn't. Okay, if my overhead was $400,000, but I applied $410,000, I applied $10,000 too much. I had over applied overhead. Okay, so if I'm under applied, my costs are understated. If I'm over applied, my product costs are overstated. And obviously, if I've been making decisions based on those costs, I might be off a little bit. So my goal is always to get these as close as possible and to keep improving every year with how I estimate so that it's as close to being, reality as possible. Okay, so that overhead variance has to be closed out at the end of the year. Usually it's closed out to the final cost of goods sold. Typically the amount is very small, so it's not a big deal. If the amount was major, supremely different from what it should have been, we might have to get a little fancier and close it out to multiple accounts. But typically for what we're going to be doing, we'll just close it out to cost of goods sold. Again, if it's large, we would then split up that variance between the accounts of work in process, finished goods, and cost of goods sold, because in fact all of them would be wrong. If we were wildly different between what we applied and what we actually experienced, all of those accounts would be very different than reality, so we would fix them all. Whereas if it's just we're plus or minus a few bucks, we're just going to close it out to cost of goods sold and not worry about it. So here's what it looks like. Okay, we had our same company that we used before had a 50% direct labor rate. So we had overhead. It says actual data. So our actual overhead was $375,400. Our direct labor was $750. Cost of goods sold is $632. It says calculate the variance and then adjust it. Okay, so for the year, our actual was $375,400. We were applying 50% based on what we experienced in terms of direct labor. So our direct labor actual was $750,000, which meant we would have applied $375,000. So you see we were $400 off. We should have applied $400 more than we did. So what we would do is when we report our cost of goods sold, we'd say we have an unadjusted cost of goods sold of $632. We're going to add $400 to it. Our adjusted cost of goods sold is $632,400. So by the end of the year, our statements accurately reflect reality, and we closed everything out and made sure that we were legitimate here. All right, when we've done these job order costing and come up with our overhead rates, so far we've done a plant-wide rate or a single rate. Okay, so a single rate means everybody in the plant gets painted with the same brush. We apply overhead based on one particular driver. Some companies find it useful to spend the time and energy to come up with departmental overhead rates because it gives them more accurate information. So departmental rate is the same thing that we just did for the plant-wide rate, except obviously we do multiple ones and we break it down further. Okay. So this is what it looks like now for our company. We have two different departments here, a machining and an assembly department, and it says they use departmental rates. So in this case, you'll see we're going to do the exact same math that we did in the previous example, but we're going to do it twice. So we're going to do it separately for machining and separately for assembly. Now what you have to watch on your homework problems and any test questions for this type of problem, you have to watch what the drivers are, because the drivers will probably change between departments. So you see right here this line. In the machining department, overhead is applied on the basis of machine hours. In the assembly department, it's applied on direct labor hours. So you have to take your overhead and divide it by one thing for one machine, one department, and take their overhead and divide it by something different for the other department. So we have to be very careful of that. Okay? And then we have the actual data. So how does that look? Okay, we just take the two separately. Here's my overhead for machining divided by my machine hours. Gives me $1.20 per machine hour as my departmental rate. For assembly, I take the $3.60 in assembly overhead divided by the direct labor hours, because that's my driver for that department, and I get $1.50 per direct labor hour. And then I apply those just like I did before, but with two separate applications. And you'll see then I have for each whether I under or over applied for each department, and I would then go ahead and close that out to cost of goods sold again. So it's the same process, you just have to be careful to keep them straight. So what do I do with all these costs when I'm done with the job order costing system? I come up with a total cost so that again I can use this for estimating and for decision making. So I take my total cost, which in this case would be my direct materials, my direct labor, and my applied overhead, divided by the number of units to get my unit cost. Okay, so it's not a big deal, but unit costs are very important because that's a key towards how we compare ourselves to our competitors, how we set pricing, how we determine if a business line is profitable, how we decide whether to go into a new market. So getting to know the actual unit cost is pretty important for us. All right, the other thing we have to do when we're a job order costing system or any kind of a company, we have to come up with non-manufacturing or period costs. So we've talked about in this chapter the costs that flow through inventory or flow through our cost of goods sold. We also have to remember there's other costs, which would be general administrative. We have selling expenses, things that aren't put into the product but are important for us to track and to make sure they're as efficient as possible and to assign responsibility for. So what I don't want you to think is because we've only talked about those product costs that those are all we worry about. We do worry about all the non-manufacturing costs, and all of those will flow onto the income statement before we're done. Okay, so that was the basics of job order costing. I really encourage you to make sure you watch the video that is on this week's roadmap on job order costing for, I think it's Washburn Guitar, because that will help you just to visualize and understand what this looks like in practice. And then we'll turn in for the next chapter on process costing. I think that'll help you by the time you're done with these two chapters to understand the difference. What I want you to keep in mind as we go through this course is we're giving you a lot of tools for managerial decision making and for analysis. You won't use all the tools at once. These are tools that are going to sit in your toolbox, and depending on the job you're doing, you're going to pull one out. So job order costing, might use it right now, might not use it for a couple years. It depends on what kind of company you're working for and what you're doing. But the concepts are going to be important no matter what you're doing. So I just want you to make sure you understand that not all the chapters and all the concepts that we do will a managerial accountant all do at once. They pick and choose depending on what makes sense for the company they're working for and the product they're doing and the particular decision that they're faced with. All right, we'll see you in Chapter 6.